Welcome to Next Economy Now. The goal of this podcast series is to highlight the leaders who are taking a regenerative, bioregional, equitable, democratic, racially just, and whole systems approach to creating the new economy. I'm Ryan Honeyman, a partner at Lift Economy. My guest today is Michael Kramer. Michael is a manager and trust steward of Natural Investments, a registered investment advisor, founding certified B Corp, and public benefit LLC, exclusively dedicated to sustainable and responsible investing, or SRI. Michael has been a Natural Investments financial advisor since 2000 and was a partner in the firm from 2007 to 2023, at which time he became a trust steward upon the sale of the firm to the Natural Investments Purpose Trust. He is co-author of the firm's third book, The Resilient Investor, A Plan for Your Life, Not Just Your Money. Michael oversees the heart rating of SRI mutual funds, now in its 32nd year, and he coordinates the firm's investment committee and shareholder advocacy and policy efforts. He serves on the Public Policy Committee of USSIF, the Forum of Sustainable and Responsible Investment, and was its board vice chair from 2018 to 2021. Michael, welcome to the show.
Thanks for having me. I appreciate it.
Yeah, I'm wondering if you could tell us a bit about your background and before you got into the work you're doing today, what were you up to?
Well, I was a permaculture teacher in the 90s, and I was a permaculture teacher trainer too. I lived in Santa Fe, where I was actually executive director of Permaculture Drylands Institute. So I was a real champion of permaculture and everything that it stands for, even before it was popular. And one of the topics in a basic permaculture design course is sustainable finance. And so this whole field captured my attention. And it was one of my favorite topics to teach. And I really enjoyed doing that. And then I also put my own money in this space as well. And so I actually became one of Natural Investments' first clients in 1990. So that's 34 years ago, the first $1,000 I ever saved when I was 23. So I've long been a proponent of this. And in fact, when I was in college, I took over the administration building at my university to protest their investments in the apartheid regime of South Africa, which was big in the 80s. And that marked my real awareness of how capital, should be a force for good in the world. And, that was my first entree into seeing how it was not being a good force in the world. And I think we had something to do with the fact that the apartheid regime changed. I don't know. Desmond Tutu seemed to think we had some connection to the change, but that was definitely my beginnings that planted the seed for doing this sort of work. So I didn't expect to do it professionally. I really thought it was personal for a while. It was a father-son company for 15 years. And when they published their second book, Investing with Your Values, and Bloomberg actually published that, which is interesting, back in 99, they asked me to join because I was teaching it. I was a client. I was into it. And they just said, hey, why don't you join us, become our third person? Back then, this was pre-internet days, so everybody would they'd cut out this little index card in the back of a book, tear it out, and mail in the postcard to get more information on the company. So they're like, we have this pile of cards from interested prospective clients, so you can hit the ground running. I was like, sure. Sounds fantastic.
Wow.
That's
so that makes
joined.
More sense with so Christopher Peck, one of your partners, is also a permaculture teacher, right?
He and I taught together in the 90s in Santa Fe.
Wow.
We were friends first. So we started teaching together in 92 and became really good friends and taught many of these courses together for many years. We're both part of Permaculture Drylands Institute. And I joined this firm first in 2000, and then a few years later invited him to join. It made perfect sense. He was already doing holistic financial planning work So it was very fortuitous. So we traveled a similar path going from permaculture to finance specifically. And now we run the firm together, which is wonderful.
And can you give folks a sense of, the book Resilient Investor, and how does the firm think about resiliency in someone's financial situation?
Yeah, so we came out with The Resilient Investor in 2015. Probably would have been a bestseller if we had published it during the pandemic, but it was 2015. And we were thinking that it was supplanting sustainability. As much as sustainability was introduced in the late 80s and early 90s, it really didn't seem to be catching on to the extent that we had hoped it would. Of course, that has changed. Now it's very widely held, although it's interpreted very diversely as well. We really thought resilience was an important new concept because it really seemed like there were certain systems that were falling apart. And the whole idea of resilience is to be able to withstand the shocks to the system. And it really seemed like there were some fundamental flaws in capitalism that investment wasn't really fixing fast enough, climate change being the most important one of which, because it really didn't seem like people understood what was happening. And so therefore we were feeling like, well, going to be destabilization on the planet from an ecological standpoint. It will contribute to social unrest, migration patterns, which is happening, right? People needing to move around and other kinds of geopolitical, strife that is climate related because of agricultural problems worldwide. So we felt like resilience was really an important thing. Like, well, how do you get prepared for disruption? And how do you sort of bounce back if there are disruptive events? And sure enough, the pandemic was a major one. And it was really fascinating to us to see people running for toilet paper as soon as the pandemic hit, rather than necessarily figuring out how they were going to feed themselves. But a lot of what we were really trying to do with thinking about resilience is, well, how do you design your life so that you have all the personal and social and tangible assets and financial assets that you can withstand any kind of major short or long-term disruption to your life. And I think a lot of people are not prepared. And so the book is a toolkit of, well, how do you consider getting prepared? Because I think a lot of people just think money is the only tool that you need. And so in our field, we talk about diversifying, within finance, your assets between real estate and other types of investments. But really, we were wanting people to think bigger. Real diversification risk has to do with your life and where do you get your food and your water and your energy, and where do you connect to your community and your social systems that are supportive for you in times of crisis. And we all live in these different contexts. How strong are those relationships? We have lots of different types of assets: personal, social, tangible, financial, and we can allocate them close to home. We can allocate them in the transnational global economy to try to be greener and more just. And then we can invest in cutting edge evolutionary things that can help humanity evolve. So that's kind of our definition of resilience. It's not just about withstanding shock. It's about bouncing back better, building something better that can help evolve humanity to be more just and regenerative in the way it looks at all systems, social and environmental. So it's a very dreamy book in that sense, because it's very big picture and it's really helping people look at their entire life. And then how do you invest your time, your energy, and your money to bring about strength in all those different aspects of your life so that you will be more resilient? So it isn't just about money. It's about time and energy too. And it is about local to global. So it's a very holistic framework. I actually think it's amazing. To be honest, never really caught on, but I still think it's got some potency there, to a way of thinking about your life and doing planning work for how to be resilient. And I think being resilient is on many people's minds now, given what's going on in the world.
I mean, our book, Next Economy MBA, sort of similar, like, wow, this is a great book. It'll sell, like, there'll be so many people interested. And then it's like, well, but I think maybe some of these ideas are things that are, like helping build the substrate for some of the conversations that, that will eventually take off. So I guess it's our contribution.
Yeah, you plant seeds and some will germinate and It's about soil fertility. You're creating the conditions, through which good things are happening. And I am an optimist, actually, because I do feel like these things are slowly, incrementally taking hold. And when you talk to young people today, they're much more further along. They don't need persuading or convincing. They're right there. It makes me very hopeful. They seem to understand things in a way that I didn't when I was their age. So it's great. I'm very encouraged.
So I didn't actually know this. Natural investments was an existing going concern that you joined onto, but now lead. Could you give us a sense of what is the history of natural investments, and then, what does the company do, just sort of level set for folks?
Well, it was started by Jack Brill in 1985. He was one of the first socially responsible investment advisors down in San Diego. And he convinced his son Hal to join, who was a friend of mine in Santa Fe. So it was a father-son team. And Jack wrote a book called Investing from the Heart in 92. And then he was part of a 7-year New York Times study. It was basically a contest with pitting him against conventional investment advisors, and they were given $50,000 to invest. And then every quarter, the Times would do a report on how their portfolio was doing for 7 years, so 28 quarters. And he did great, even though the industry was completely immature and the amount of options that were available back then were slim. And it really demonstrated that this was a credible approach. Back then, there was this mythology that, this must be charity. You can't make money by layering your values onto your investments, and, you're foolish. And so once that study concluded and they wrote that second book right at the end of that study, that's when they decided to expand and technically form Natural Investments, because it was just him and his son for the first 15 years. So that's when I joined in 2000. And then in 2007, there were a few others of us who had joined in that interim period. And Christopher Peck and I bought into the company as part owners with Hal Brill, Jack's son. And the three of us owned and operated the company together for about 10 years. And then we started to sell some of our shares to a few other advisors. And so we were 6 advisors who owned it until last year, when we all decided to sell to a perpetual purpose trust, which I know we're going to talk about later. So the firm has always exclusively done socially conscious investing. It's just like any other investment advisor. We do IRAs and we do brokerage accounts, but we also do private investments, and we always have. Community development finance to try to address poverty, and loans to people of color and women and marginalized populations, but also, trying to invest in more conscious companies, the green economy. We've been doing fossil fuel free investing for 12 years now, long before it was popular. And so just really trying to listen to people. What do they care about? What do they want to stay away from? What do they want to support? And trying to match those values with their portfolio. So we've been designing those portfolios now for 39 years. So the other thing that we do, besides managing, people's money and giving financial planning advice to our clients, is we publish on our website what's called the Heart Rating. And that's been going since 92. And it rates the socially responsible funds on a scale of 1 to 5 hearts based on how comprehensive their approach is. One of the challenges in our space is that people think all of these socially conscious investments are the same in terms of their criteria, and they are nowhere near the same. And we have known that for over 30 years. So we thought it was a good public service to rate them. How broad and deep are they going, and how they look at what is responsible to hold. And so that's out there for the do-it-yourselfer investors, but it's also for us. We want to know, for the investments that we're recommending to our clients, who is really serious about this stuff and who is greenwashing, who is weeding out tobacco and calling it a day, and who is really serious about looking at company practices and what are they really doing with their employees and their customers and their communities and the environment. There's so many dozens of issues that you can look at in terms of defining responsibility. So something that we're very proud of, because it is a very rigorous standard, and it really lets people know that there's a huge difference out there, and people should not be fooled by glossy brochures and slick marketing campaigns about what is green or socially conscious.
Great. And so maybe bring us up to speed. Maybe before we get into Purpose Trust, Kate Poole and Tiffany Brown from Cordata, or they helped form Cordata as a part of Natural Investment. Maybe could you explain
how that works?
How that whole process worked, and maybe for folks who don't know who Kate and Tiffany are, could you just say briefly?
So I'll back up first and just say that we all own our own practices. We're not employees of the firm, so we're like a collective of independent advisors who pool resources and technology and knowledge so that we can all be better by being together. However, some people just want to have their own brand for their practice. And Cordata is the latest in a series of several folks who have joined us who have their own brand, and they have their own website and they have their own brand, but they're part of us. So each office gets to decide what their business model is, what they want to focus their investment strategies on, what types of minimums they have, what types of services they offer, what types of clients they want to work with. And everybody's a little bit different. And so Cordata, they're exclusively focused on private impact investments rather than the publicly traded. Others of us do both. And some of us just do the public investments. So it really just depends on the advisor and what do they want to focus on. So we see ourselves as a big umbrella under which many different types of advisors can hang their shingle and do what they feel called to do. But it's all values aligned. And the great thing is that we can all do due diligence together and co-invest in things together. And that's what's so exciting, is because if somebody identifies a really amazing opportunity and shares it with everybody, we have almost $2 billion under management now. You can really make a nice investment in something as a firm if it's shared with others. So that is really wonderful. We can do a lot more significant impact that way. So that's a little bit about the structure of how we operate. So we're very non-hierarchical. So I have my own clients. I'm a financial advisor, and I help run the firm and make sure that it works. We don't have a central back office with executives and we're all just reps in the field. That's the typical business model for this business. That's not how we are. We're all advisor run. So the decisions that we're all making are for us. We're not making them for other people who have different roles. So that has helped people, I think, feel a sense of true ownership of process. There's no us and them. There's no management and labor here. So that has been something that I've really appreciated about our structure.
I think that brings us to the Purpose Trust conversation, which actually adds some interesting nuance to how you would actually do a Purpose Trust if you're not even it's not one entity. There's several, people. So maybe bring us, when did you learn about Purpose Trust, and what has been the conversations, and then how did you make the decision to do it?
Our original plan was to continue selling our own ownership stakes to younger, newer advisors. We had this fantasy of, we could have 20 people each owning 5% of the firm. That was some idea that we had. The problem with getting successful in this business is that the valuation of your company goes up, and then it becomes prohibitively expensive to sell. The price becomes too high. And we were already starting to see that with some of our younger folks. They were like, yeah, we'd love to buy, but we can't, And then we were starting to think, gosh, this could take 30 years to do it this way. So we were realizing we needed to maybe come up with a different solution. Coincidentally, we learned about an investment opportunity for the Organically Grown Company, a natural foods distributor in Oregon. And they were seeking capital to do a conversion of ownership to a perpetual purpose trust. And they got in touch with us because I think we have a bit of a reputation as a cutting edge firm. And so we had some clients invest in their transition to exit their owners and convert their company to a purpose trust owned company. And that was back in 2018, I think. And so as we were doing our due diligence and just learning more about that, it dawned on us, hey, maybe we should take a look at this for ourselves. So and a lot of people thought that. So the Organically Grown Company created a consulting arm to try to respond to all the inquiries that were coming to them for their ownership conversion. So we hired those consultants and we spent a full year with them looking at various alternative ownership structures, seeing which ones would be a good fit for us. And, some like co-ops and ESOPs and other things are really good for when you have employees, but we don't have any employees. So that wasn't going to be a fit. So the Purpose Trust ended up being a really nice fit for us. And it took us about a year to figure that out, to really figure out, okay, what makes the most sense for us. And so that's what we decided to pick. And yes, even though people own their clients and their own businesses, the firm does have its own value because the firm takes a percentage of everybody's revenue to operate and to cover all of the expenses for everybody. I mean, people might have their own expenses if they have a physical office and they have to pay rent, but the rest of the expenses to operate an investment firm are covered by the percentage that we take from everybody. So there still is a lot of revenue that comes into the firm. It's all centralized in that way. And then we pay out the advisors their share of the earnings from what clients pay in annual management fees. So the trust was something that we thought made the most sense. And we presented this to all of the advisors a couple of years ago, maybe 2.5 years ago. And we wanted to see if everybody bought into it, and they did. They loved it. They thought it was great. And, one of the pieces that was brewing and emerging during this time was trying to shift power out of the hands of white men. And despite our good intentions, we were still white men running the firm, owning the firm. 3 white men were owning the firm. When we got to 6 owners, we were still 80% of the owners were white men. So there was a real desire to shift all of that, to shift all the power dynamics, and to not have that take forever, because in a typical LLC structure, voting power is tied to ownership stake. So if you're a 1/3 owner, your vote counts for 1/3 of the total. And so we were seeing that converting to a trust could instantly change the power dynamics. Because in a purpose trust that has essentially a board of trustees, the power is shared equally by everyone, just like a board of directors for a nonprofit organization. So nobody has an outsized voice or power. So that was very attractive to the team. That was, I think, another convincing factor. Yes, the past owners needed an exit. They needed to get out. They needed to sell. And it needed to be at the market rate, the actual value. But we also wanted to address these power dynamics and not have to wait 10, 15, 20 years for those types of dynamics to change. So it seemed like the best of both worlds were possible with making this choice. And it turned out to be true. But I'm just saying that was the thinking.
That's great.
That was the thinking. And we nailed it, I have to say. We got it right. Because a little over a year ago, we did elect trust stewards. The advisors all elect trust stewards. That's what's great about it. It's just an election. Anybody can be nominated if they've been here at least 2 years. And we have people step up and want to serve. And we have 7 trust stewards. Now, 4 of the previous partners and owners moved over to be trust stewards for the sake of continuity, and that makes a lot of sense. You can't just hand a firm over to people who don't know how to run it. But we brought on 3 new people and instantly changed our demographics. So, now we're nearly half women, and we've got, 2 people of color out of the 7. So it instantly changed all the dynamics. And they didn't have to go into debt to have the power. And that was the other exciting thing for us, is that we didn't really like the idea of all that debt upon individuals. That's a serious thing. And so one of the nice things about a trust is that the debt is actually assumed by the firm, not by individuals. So the company can borrow the money to pay off the old owners. People don't have to do it. The old model that we had was individual owners were having to make deals with other individuals and set up promissory notes, and it was a transaction between individuals. And that's just removed from this equation. There are no individual owners. The trust is the sole member of the LLC. It's the owner. And so individuals no longer have to worry about that. Those were all the reasons why we thought this was the right decision to make.
It's fascinating. And sort of like process questions, Which attorney did you all use to set it up?
We used Jenny Kassan,
Oh, yeah.
who's one of the attorneys who knows how to do that. There are only a handful in the country. And we interviewed a couple, and we picked Jenny Kassan, who's in the Bay Area. It took another year to facilitate the transfer. We had to design the trust. We had to set up the financing, orchestrate all the legal agreements. There's a lot that an attorney needs to be involved in. And thank goodness we had consultants to help us. And I'm happy to share their info as well. But yeah, there was a lot we didn't know how to do. And so it is really important to get help. And so the consultants were really helpful in just laying out process, and the attorney is really helpful in organizing documents and getting them all filed.
Was this the folks from Organically Grown?
Yeah, so Organically Grown spawned off something. It was called Alternative Ownership Advisors at the time, and Peter Kohler and Natalie Reichman-White were the two leads there. They have since, Organically Grown has since spun that all off, and now they have a firm that's their own called Purpose Owned. And that's what they do, is they just help companies to do these conversions. There have been 50 conversions so far to trust ownership, but there's more in the hopper every day as this catches on. It seems like it's a real great solution for founders. That's what we're seeing the most use, who don't want to sell to a larger firm. That's what happens to a firm like ours. As soon as we reached $1 billion of assets under management, we're getting hounded all the time from larger firms that want to scoop us up. As soon as you reach $1 billion, that's what happens. We didn't know that was going to happen, but we get inquiries all the time. Oh, we'd love to have a socially responsible division in our firm. Oh, we have $8 billion. Well, you'd have a good home here with your $1 billion. And they aren't even thinking about the values alignment. They just see dollar signs and try to convince you. But they know you want an exit, so they dangle lots of financial carrots in front of you. Oh, we'll pay you double what your valuation is, and it's tempting. That's the normal course of action for a startup, even for a seasoned veteran type business like ours. The temptation to sell is out there because people offer a lot of money. But that was never our motivation. We wanted to retain autonomy, our culture, our independence, and the fact that we're run by ourselves. And you can't do that if you sell. And we've seen it in our industry, what happens when that does happen, and people do lose power and they do lose control. And then they could sell to a larger company after that years later. And we didn't think that's good for our clients. It's not why our clients picked us. They picked us because of who we are. And it's just in our DNA to want to preserve what we have, I think, in perpetuity. And that's why a perpetual purpose trust is great, because it would be so difficult to sell the firm with this structure. There'd have to be consensus to do it.
If you're an owner of a company, like let's say you were an owner of a similar size firm, but you were not necessarily mission oriented, and a purpose trust was put in, like what are you losing as a traditional capitalist business owner when you go to a purpose trust? Like you don't get that 1/3 vote, you were saying? You don't get the controlling votes?
You don't have any control, yeah, because the power is distributed across all the elected trust stewards. We call them trust stewards, but they're trustees basically. So yeah, I went from having 1/3 of the voting power to 14% of the power. It used to be that Christopher and I, we had 2/3 of the power just by our ownership stake. That's removed. So it's a little bit of a risk there. The owners have to be willing to give up power. Because once you do that, who knows what kind of decisions could be made. There's a lot of trust. There's a lot of faith you have to have that the people that you're bringing in and the people who are being elected are going to maintain the same values and culture and direction. And it's a huge risk, I would say. Now, it felt okay for us because we know our people. We think we know our people, and we think we know that they're going to want to keep things the way that they are. But even if they don't, if that's what's meant to be, then that's what's meant to be. And at some point, we just need to cycle off and allow that process to evolve. And we were partners for 16 years. That's plenty of time. It's okay to give up that power, to share it. I think we've set enough years of how we operate to kind of indicate to people what it is. And you would hope that people would want to continue that, but they don't have to. The majority could move us in a different direction somehow. So it was a risk we were willing to take.
And I guess it's a way of, how did you line up the finance? Because I imagine, so the trust where you have to like get financing to buy out your shares and Christopher's shares and the other, was that how?
Yeah, the other four. The LLC, and we became a public benefit LLC through this process as well last year, which was a nice bonus under Delaware law. The LLC is the one that's handling all the financing. So it's the one borrowing and paying all the previous owners. So we decided to structure it in 3 buckets. The first is a down payment, which is borrowed money from a community development financial institution. We used RSF, social finance, which has been around for over 40 years and could handle a loan of this size. And so that was for a quarter of the value. We had to get an independent appraisal from a valuation firm, and we used their numbers. So it was not overinflated in any way. It was just using the independent sales price value. And then for the other 75%, we had a combination of promissory notes, fixed interest notes to the 6 previous partners over a period of years. And then there's earnout. And earnout is an annual variable amount based on the profitability every year of the firm. And so there's a formula there that if the firm has X amount of profit, the ratio that would go to the previous partners versus profit sharing to the firm's advisors, that ratio is codified and it changes depending on how profitable the firm is. And that also is going to happen over a number of years. And it has a ceiling of what the maximum could be to be paid out to the previous owners. We're not trying to gouge the firm here, but because we are taking the financial risk, because we don't know what's going to happen to the firm or the economy or anything, we are giving the possibility that there could be some financial upside to this. If the firm grows, then the previous owners will benefit from that because the value of the company will go up, and so therefore there could be a benefit. Of course, if the value goes down, then the value goes down. We think that's unlikely, but you never know, right? So it's just a risk that we were all willing to take over a number of years, and some of us it's going to take 15 years for people like Christopher and I to be fully paid off. But that's okay. It has to make sense from a cash flow perspective to the firm. And profit sharing is a core piece of why we made this change. And it's equal profit sharing to all advisors, regardless of the size of their book of business and revenue. So that is codified too, that every year there will be something. And that was really critical to us, that people immediately feel the benefits and in perpetuity have some benefits. And obviously there's a lot for debt service right now, but that will decrease over time. And, eventually there will be a lot more to distribute as profit sharing. That was another key motivator for us. When you're an individual owned LLC, the profit sharing is also distributed based on ownership percentage. So it maintains a lot of the inequity, the people who own more, sure, they had to buy in and they had debt when they bought in, but they get the majority of the benefits over time. So we have removed all of that and feels really good to have done that.
In the last couple questions here, how does this intersect with your racial justice journey the firm has been on?
Yeah, in addition to these ownership changes so that the demographics of the trust stewards are now much more diverse, which was really critical. It really fits with our long-term objectives. We had hired a consulting firm to do a racial equity audit of our firm and everything, 360 degrees, everything that we do. And we have been implementing some of those recommendations for the past 4 years. We have a permanent racial equity team of advisors that's focused on this work and working on everything from professional development to reparations payments to advisors of color who join the firm, to our charitable contributions. We have a policy that's where we have to donate at least half of the money to racial equity and justice causes, to upping our game on the percentage of investments that we're making in racial and equity and justice. And we're at, I think last year we did 65% of our private investments had that focus. But it's also internal, looking at how white male bias affects the way we lead the firm. we've been getting some coaching help and just trying to understand how the different experiences and lenses that we all bring to an organization might affect how we run it and affect our ability to be sensitive to life experiences of others. So really trying to increase our awareness, and that's been very, very helpful. Even trying to figure out, well, how do we resolve conflicts when they arise, when people say insensitive things they don't necessarily mean but are harmful anyway, And so, we're learning from those kinds of experiences. Like when we make mistakes, how do we deal with that? So it's been very, very good interpersonal work, and I think that the ownership change is just a further reflection of our commitment. But ultimately, the work happens at the day-to-day level. It's sort of how do you deal with each other? How do you make decisions together? And how do you walk your talk? Because you can come out with glorious statements of being a good ally, but you really have to prove it. You have to show that how are you an ally? And there's many different things that you can do to do that. So we're taking that very seriously, and we're very committed to that.
I mean, I do want to say that ownership structure, like, you talked about, we were 1/3 of the owner. You literally have to give up power and ownership. And I think it's nice for companies. It's nothing against having like a DEI committee or like talking about it, but then like changing the ownership structure to actually reflect it is really powerful. And so just want to appreciate you all for like leading in that, like, let's actually do this at the ownership level and not just talk about it. So thanks for that work.
Yeah, thank you. Feels good.
Yeah.
We really want to encourage other people to do it. I mean, it's time consuming. It's not that difficult. It can be done. And one of the reasons I wanted to talk about it is because I really do want other people to do it. I do think it is one of those things that can really change the institutional racism that exists. In order to change that, the institutions themselves, the businesses, have to change how they are owned and operated. And this is one of many different ways to do that. But I'd like to see more folks do this. It's innovative, and I think it works. And we're only a year in, but still, I think it works. I can tell, that it's the right approach.
So, Michael, where can folks go? Website or other resources you want to throw out there for both natural investments and maybe also any like purpose trust resources or anything you want to throw out?
Well, naturalinvestments.com is surely our website. And if people are interested in our book, The Resilient Investor, that's resilientinvestor.com. But you can find the book at any independent bookstore. Purpose Owned is the name of the consultants that helped us, purposeowned.com. Natalie and Peter are the primary principals there. And this is what they do full time. And so, it's a really great resource. And again, Jenny Kassan was our attorney in the Bay Area. So there's people out there, I think, who can help. Yeah, we're always interested in people who want to align their money with their values. So feel free to reach out to us if that's of interest.
Well, again, thanks so much for joining. And really excited to spread this message about the purpose, because, Patagonia sort of did it. And a lot of people feel like, well, they're Patagonia. It's almost like unreachable levels. And so to hear more sort of everyday businesses do this, it's really inspiring. So thanks for joining.
My pleasure. Thanks for having me.
Next Economy Now is a production of Lift Economy. To listen to all of our episodes, go to lifteconomy.com/podcast. That's LIFT economy.com/podcast. You can also sign up for our monthly newsletter at lifteconomy.com/newsletter. Please also rate and review our podcast on iTunes, Spotify, Stitcher, or wherever you get your podcasts. Thanks for listening.